Hello there. Well, we always call these market updates the pulse. The reason is we like to give you sort of up-to-date information about what's moving markets and what changes we're making to investment portfolios. But of course, we always say that investing should be a long-term business. You shouldn't be investing in our core portfolios like the cautious or the balanced fund, for example, unless you can afford to tie your money up for at least 5 years, because markets can be very, very volatile. So we need to be careful differentiating between what might happen in the short term and what might happen in the long term. When we are looking to make investment decisions, we're always thinking about the long term. It might be something that we think might do well over the next weeks or months, but really the test is, do we think it's going to give us some good performance over the next 2 years or more? So it's very important to think about that, the different timescales. I think also at the moment it's important to accept that there are lots of things we just simply don't know. We don't know any more than anybody else what's going to happen with Ukraine and Russia. We don't know if it's going to end tomorrow, if it's going to drag on inevitably, if it's going to get worse. We just can't say. So we have to be careful about making any investment decisions around that. But having said that, if there is something that over the long term we really want to hold, we think has got some really good long-term growth prospects, and short-term market volatility means we get to buy it at a cheaper price now, then that is the sort of investment decision we're comfortable making at the moment. So we'll give you some examples. One of the things I think we can say about the current situation is it's adding to inflationary pressures. And so one of the ways we like to protect portfolios against inflation is to have what we call real assets, things like infrastructure, things like property. Right now, we think infrastructure is a great thing to invest in, and we've been topping it up because not only do we get to buy it at a cheaper price because of markets, but also governments are now looking at spending more money on infrastructure, particularly around energy and renewable energy. So that's something we thought was already a positive long-term trend, and the current situation, I think, will mean governments really try and push that area. Similar with property, we really like industrial property at the moment. And actually, if we look at the underlying buildings in the industrial property sector, according to the CBRE, the property valuers, that's gone up about 4% so far this year in terms of total return. But the industrial property fund we hold fell, because it's listed on the stock market, fell about 14%. So again, to us, something that's doing well, that the underlying asset is up 4%. If the shares are down significantly and we get to buy in at a lower price, that makes a lot of sense. So all we're doing at the moment is just reallocating capital to those areas that we think have got some really good long-term prospects that we get to buy in at a better price. Now, of course, one of the problems with doing that is when we're buying on the way down, we might be making things worse. As markets fall, portfolios are inevitably losing money. If we are topping up equities or related assets and we're not got the exact bottom of the market, then we'll make things worse in the short term. But that is something we're willing to accept because we're looking at long-term gains. We can never call the bottom of the market. So I think just talking about taking a long-term view is really important at the moment, especially when we look at returns, which, as I said, portfolios are all down so far this year. I'm going to put on screen the returns of our cautious, balanced and adventurous portfolios against the average managed fund, the average mixed investment fund that has between 20 and 60% in shares. And what you can see on here is the discrete annual, the calendar year returns for each of the last 10 years, and then what each of the portfolios have done so far this year. So this year, cautious, they're all down, but cautious has fallen the least and has fallen less than the sector. Balance has fallen just slightly more than the sector, and adventurous has fallen quite a bit more. That is probably what we would expect, given the amount of risk that we're taking. But if we look at some of the previous years, you will see what tends to happen when the sector rises is adventurous outperforms. when the sector has fallen in the past or has provided some fairly low returns, you see cautious is more likely to do better. And balanced tends to be fairly consistent across the middle. Cautious has outperformed the sector 7 years out of the last 10. Balanced 8 years out of the last 10, and adventurous 9 years out of the last 10. So, and what's quite interesting is the last time we saw, a short-term piece of underperformance. For example, you can see 2016 and cautious and balanced both underperformed the sector slightly. The next 4 years, for example, for balance were really good. So sometimes I think it is important to just remember the long term and not worry so much about the short term. I now want to put up just to show you as well the total returns of each portfolio over the last 10 years. And rather than just show you a line chart, what we're showing you on screen now is a scatter chart which shows both risk and return. So the further up the chart something is, the higher the return has been. The further to the right something is, the higher the risk. You can see cautious has taken the least amount of risk, but still outperformed the mixed investment sector. Balance took a bit more risk than the sector, but outperformed by a longer way. And adventurous took even more risk, but was more volatile, but outperformed significantly. That is what we would expect over the long term. More risk, more return, but in the short term, of course, the riskier portfolios are more likely to fall further. So before I finish, what's working in the portfolios and what's not working at the moment? Because we try and have a diverse mix of assets, but some things will be working better than others. And there are some things in there that are doing really well. Some of our defensive assets have held up nicely. What's not working so much at the moment is some of the things that we think are great long-term places to invest. Things like smaller companies tend to outperform over the longer term, but in the shorter term, they're falling. Emerging markets tend to outperform over the long term, but in the short term, they're underperforming. Again, if we put up on screen, these are our UK funds, the UK equity funds that we hold in portfolios. I've got on there both the returns so far this year in 2022 and the 3-year returns. Now, all of these funds have got a small cap bias. So this year, what we've seen is they've all significantly underperformed the FTSE. If I were to put the FTSE 250 on there, for example, or the FTSE AIM index, you would see small caps generally have been underperforming. So our UK equity funds have done really badly so far this year, unfortunately. But we can't make decisions based on those short-term moves. If we look at the 3-year returns, all of them outperform the FTSE and all of them have done so significantly. So we base our investment fund decisions on that long term as well. So one of the things we've been doing is we've topped up those smaller companies as markets have fallen. So again, something we think has got some really good long-term prospect, but we can buy at a cheaper price. And one of the ways we've been able to fund that is by taking some of the money from a couple of the defined returns that have kicked out. So we've had two defined returns products kick out so far this year, which has been really useful. They've provided some really good returns over the period we've held them, but it's also given us the cash to then take that money and put into equity markets, put into real assets, and a little bit more defined returns at a lower price. So there's lots going on at the moment, and as I say, at the moment we can't predict what's going to happen with the situation with Russia and Ukraine. If markets carry on going down, then those actions that we've taken will make matters worse in the short term. But I think back to what happened in 2020 during the pandemic. There we saw a similar thing. We bought on the way down, and in the short term that meant losses were steeper. But over 2020 as a whole, we ended up with actually some really good returns, and that added to long-term performance. So I think the same thing could be true now, but right now we're being slightly more cautious than we were in the pandemic. We're putting we're putting money to work, we're investing money in equities, related securities, but in smaller incremental steps. And we think that's the right thing to do with so much uncertainty right now. So hopefully that's given you a bit of a flavour of our thinking and the way that we go about managing the portfolios. As always, if you've got any questions, please do get in touch. Thank you.